Once an individual knows his taxable income, then it is possible to calculate the amount of income tax he is required to pay. A tax table, such as the sample shown below, is used to determine the amount of tax owed. The first thing that must be established is the person's family status. Is the person single, married filing separately, married filing jointly, or head of household? Each group follows a little bit of a different scale. Notice that a person will not pay a blanket percentage of their taxable income. Instead, their income is going to be broken up into segments, and a person will pay a different percentage on each segment of his income. What you see over here on the left, the tax rates, these are often referred to as the marginal tax rates. Marginal because they're over here in the margin of the table. So what we're going to do is take the taxable income and we're going to apply different percentages to that income as it scales up. So let's focus on the single column here. A person who is single is going to pay 10% on the first $8,700 that they make. Then every dollar earned above $8,700 but still up to $35,350, that chunk they're going to pay 15% on. Then beyond that $35,350 up to $85,650, they'll pay 25%. So again, we are breaking up taxable income into chunks or brackets and applying an increasing percentage for each portion of income. It's important to realize that we do not pay a single percentage applied to taxable income, but our taxable income is broken up into segments, and we pay increasing percentages on each segment up to some point. Also on this tax table, you can see the standard deductions and exemptions per person for the different categories. Don't forget with the standard deduction, if itemized deductions are larger than that standard deduction, then that would be the deduction that we would take. Here's the procedure for calculating tax. To calculate the amount of income tax an individual owes, do the following. Number 1, determine the AGI, adjusted gross income. Recall that the adjusted gross income is the gross income minus adjustments. That was from the previous video. Then determine the taxable income. Remember, the taxable income is the adjusted gross income minus exemptions and deductions. Okay, once that is done, then the income tax is going to be the tax computation that we're going to get from the table minus possible tax credits, which again reduces the amount of income tax that you pay. And those tax credits are set by the government. All right, are you ready for this? I think we are. Example 3. Use the marginal tax rates from the table on the previous page to compute the tax owed by a single man with a taxable income of $40,000. So this man has already gone through the first 2 steps to determine his taxable income. Now we're going to use the tax table to figure out exactly how much tax he's going to pay. Glancing back at the table, if his taxable income is $40,000, then notice a portion of his income is between 0 and $8,700. A portion is still less than $35,350. And remember, he makes $40,000, so he has made between $35,351 and $85,650. That means he is going to be charged these 3 different tax rates on those chunks of his income. Now, let's make a table to keep all this information straight. I'm going to write down those increasing tax rates. There's going to be 3 that apply to this man. let's look at the value of his income that particular rate is going to apply to. And then let's look at the tax owed. This is going to be the actual amount in dollars that he's going to owe. The three tax rates that are going to apply to him are 10%. Notice I have already converted it to a decimal. 15%, that's 0.15, and 25%. Recall from the table that the first $8,700 that one earns will be charged this 10% tax rate. So we're going to take percent times amount, 10% of 8,700. Remember, to find 10%, you just move the decimal one place to the left. So he's going to owe $870 on that first $8,700 that he has earned. But don't forget, his total income is $40,000. So next, we're going to figure out the amount of his income that is between the $8,700 and the $35,350. So what we're going to do is take the top value, $35,350, and we're going to subtract the $8,700 that he has already paid taxes on. So we have $35,350 minus $8,700, and that gives us $26,650. So he's going to pay a 15% tax on that chunk of his income. Let's see how much that's going to be. So I'm going to take the $26,650. The calculator is going to remember it if I just enter the times button, times 0.15, and on this portion of his income, $3,997.50. $39.97.50. Let's glance back at the tax table to understand the next step. Now remember, his total income is $40,000. So the third tax bracket that he's going to pay is this 25% tax bracket. His $40,000 income is between these two values. Now, he's already been charged on the first $35,350 that he has made. We want to figure out beyond that $35,350 up to his income, how much money is there. So we're going to subtract. So we're going to take his income, $40,000, minus the $35,350, and that's going to give us that amount of money for that tax bracket. Okay, the reason we're using $40,000 and not the top value in the table is because his income did not exceed the $40,000. So $40,000 minus $35,350 gives us $46,050, and he's going to owe a 25% tax on that last portion of his income. So I'm going to multiply that by 0.25, and on this portion he owes $1,162.50. Now, to be sure you understand what we did, I'm going to show you one little step you can do to check to make sure that we portioned his money correctly. I'm going to sum all of those chunks of his income. The first $8,700, remember, got a 10% tax. Then, beyond $8,700, the next $26,650 that he made, he's going to be charged 15% of that. And then on the last $4,650, he's going to be charged 25% tax. Notice that sums to his total income of $40,000. So we have properly proportioned his income. Now, to figure out how much tax he owes, we're actually going to sum all of those tax calculations. So let's add the $870, the $39.97.50, the $1162.50. So all of those tax calculations give us a total of $6,030. Okay, so when we sum all of these, we get $6,030. So, of his taxable income, now remember, he probably made more than that, but the taxable portion was $40,000. He will owe $6,030 for income tax. It feels like bad news, but remember, we all enjoy the roads that we drive on, the parks that we get to enjoy, the schools and our education system provided for our kiddos for free. So we'll try and stay focused on the positive, right? Okay, let's do an example of the entire thing. We're going to start with calculating taxable income and then use the tax table to determine tax. Example 4, calculate the federal income tax owed by a single woman with no dependents whose gross income adjustments, deductions, and credits are given below. And we're going to use the tax rates from the example table on the previous page. So in order to calculate this single woman's tax, first of all, we need to know her taxable income. And the first step for taxable income is to get her adjusted gross income. So we're going to take her gross income minus adjustments. Her gross income from the information given is $62,000. And we're going to subtract her adjustments. Her adjustments here are $4,000. Notice she is saving for an IRA. That means individual retirement account. We will spend an entire section learning about those. It's going to be really useful and exciting information. So $62,000 minus $4,000 gives us $58,000 for her adjusted gross income. Now, the next thing we need to do is calculate her taxable income. To calculate her taxable income, we're going to take her adjusted gross income minus exemptions and deductions. So her adjusted gross income is $58,000. Now, her exemptions are going to come from the table. Remember, we're dealing with a single woman. Her exemption is going to be $3,800 for herself. She has no dependents, so we're going to subtract $3,800 for her. Now, her standard deduction, remember, I hope you're not getting dizzy from all this scrolling. Her standard deduction is $59.50, but I want to compare standard deduction to itemized deductions and see which one is bigger, okay? So I'm going to make a quick little note right here. Standard deduction is $59.50. And these are her other deductions. So $7,500 in mortgage interest, $2,200 property taxes, $2,400 charitable contributions, and $1,500 in medical expenses not covered by insurance. Now, one thing that we need to point out for the medical expenses, we can only deduct those under certain conditions. So let's make a note over here. We can only deduct values which exceed 7.5% of a person's adjusted gross income. So some medical expenses, when someone has a medical emergency, you know how quickly those expenses can explode. However, not every single dollar beyond what's covered by insurance is deductible. Only those dollars that exceed 7.5% of adjusted gross income. So let's figure out what that is for this particular woman. So 0.075 or 7.5% of her AGI, which we calculated as $58,000, would be 0.075 times 58,000, $4,350, $4,350. Since her medical expenses did not exceed the $43.50, then she cannot count that as her itemized deductions. So that's one of the things that makes calculating income tax so intimidating, is all of the rules and laws and the knowledge you have to have in order to make those calculations correctly. In that case, that's when an accountant or a personal financial advisor can be really, really helpful to make sure that you don't pay too much tax. Okay, let's sum what's left of her itemized deductions. So we're going to add her $7,500 in mortgage interest, $2,200 in property taxes, and $2,400 in charitable contributions. That sums up to be $12,100. So her itemized deductions are $12,100. That exceeds the standard deduction, so that's the number that we want to subtract. So let's subtract the $12,100, and we'll have her taxable income. So $58,000 minus $3,800 minus $12,100. Her taxable income is therefore $42,100. So what that means, remember, her gross income was $62,000, but she's only going to pay tax on $42,100 of that. All right, we're halfway there. Now we're ready to calculate the amount of income tax that she's going to owe. To keep it all organized, again, I'm going to make a little table. Let's look at the tax rates that will apply to her. Let's look at the value of her income in that particular tax bracket. And let's determine the tax she owes on that chunk of her income. Now, looking at the table, remember the first $8,700 is in the 10% tax bracket. Okay, so we're going to calculate 10% of 8,700, 0.1 times 8,700 is $870. Notice that's the same as our single man up here. That's always going to be the same as long as your income exceeds $8,700. Okay? The next tax rate on the tax table is 15%. And to remind you, that's going to be all of the dollars that she earns above that first $8,700 up to $35,350. Now remember, she earned $42,100, so she's in between these two numbers, okay? So for the next part, it's still going to be the same as our single man from the previous example. We're going to find the difference in these two values, or the difference in $35,350 and $8,700, which we did right here. And we're going to get $26,650. Again, that's going to be the same as long as your income exceeds that particular tax bracket. So $26,650. 15% of $26,650. What did we end up with up here? We got $39,9750. Okay, now the next tax bracket is a 25% tax bracket. Remember that her taxable income is $42,100. So $42,100, let me clean this up a little bit so we can look at it. $42,100 lies in between these two values. So we're not going to charge her 25% up to this value. We're only going to charge her 25% on her income beyond the $35,350 up to her income, which lands somewhere in the middle. So we're going to take her $42,100. We're going to subtract the $35,350 that she's already paid taxes on, and that's going to give us the amount of her income in that tax bracket. $42,100 minus $35,350. $67.50. So we're going to charge 25% of $6,750. And that will give us $1,687.50. tax for that particular bracket. So you've probably heard someone talk about moving into the next tax bracket. If your income increases enough to move you into the tax bracket, then that very upper portion of your income has a much higher tax rate. Okay, let's make sure that we've done this correctly. I want to remind you of how you can check to make sure you have everything in the right place. I'm going to add all of those different values where we have portioned her income, or we've partitioned it into brackets. Whoops, I'm going to add those. 8,700 plus 26,650 plus 6,750. That gives us a total income of $42,100. So we know that we have properly partitioned her income. Then we're going to add all of her tax values, and this will be the total income tax calculation for her taxable income. 870 plus 3997.50 plus 1687.50, and we get $6,555. But wait, there's one last detail we don't want to overlook from this problem that we haven't seen before. So the amount of tax that she owes is $6,555. But remember, we are told that she is given a tax credit. So to calculate the amount of income tax that she owes, we're going to take the tax computation, that's the $6,555 that we just determined, and we're going to subtract yet another benefit, a tax credit, of $500. So the tax that she owes is our tax calculation, $6,555 minus the $500 tax credit. So she's going to owe $6,055. And if you live in Texas, you don't have to pay state income tax, so that's good news. You just have to worry about your federal income tax. But I hope that this particular section is not only helpful for you to be able to do your homework, but also to discern all of the different parts of your own personal income taxes.